Hello, this is Sylvia of CPD Books, and in this video I will be responding the question related to the hedge effectiveness prospective test versus retrospective test, especially in the light of the rules in IFRS 9 because there was a change from IAS 39 a few years ago. Today's question comes from Sumit from India, but he's not the only one. In fact, many readers ask me the same thing, which needs clarification, so here we go. Under IFRS 9, we are required to test the hedge effectiveness prospectively, and we can use the qualitative methods, for example, the critical terms matching. Does it mean that there is no need for quantitative retrospective testing of the hedge effectiveness? Here we are talking about cash flow hedge of forecast transaction, and all the critical terms of hedged item and hedging instrument match, and the hedge is designated at day 1. I believe that if all terms match, then the hedge is 100% effective always, and there is no need for quantitative testing. Okay, so that's the end of the question, and my answer is not at all. It is true that IFRS 9 introduced some changes into the hedge accounting, and one of them was prospective evaluation of the hedge effectiveness. So this means that you need to assess whether you expect that the hedge will be effective in the future. This is why it is prospective, because it's looking to the future. But it doesn't mean that you're never going to look back. When you enter into the hedging relationship and you want to apply hedge accounting, you need to do two things related to the hedge effectiveness. Number 1, assessing the hedge effectiveness, and number 2, measuring the hedge ineffectiveness. Okay, so let me explain both of them. First, assessing the hedge effectiveness. This is so-called prospective test because you need to assess whether you expect your hedge to be effective in the future. So in fact, you're assessing 3 aspects of the hedge effectiveness. There is economic relationship between hedged item and hedging instrument. Credit risk doesn't dominate, the value changes from that economic relationship, and there is appropriate hedging ratio. You need to do this assessment at the inception of the hedge, and then at each reporting date at every time when the circumstances of your hedge change. And how are you going to do that? Well, there are a few methods, both quantitative and qualitative, and I'm not going into too many details now, but just let me name a few of them. Well, you can apply the critical terms matching, just as was mentioned in the question. And this is qualitative method because you do not perform any calculations. So at the start of your hedging relationship, you're going to compare the terms of the hedged item with the terms of the hedging instrument, and you're comparing the maturity dates, the currencies, interest rates, notional amounts, well, whatever relates to the situation. This method is used for simple transactions like simple forward contracts hedging the forecast transaction. You can also apply the simple scenario analysis method, and this is the quantitative method, and you are going to simulate various scenarios and analyze how the fair value of your hedged item and hedging instrument changed as some other variable changes. And you can also use the linear regression method and Monte Carlo simulation method. And these methods are quantitative. They require a bit of modeling and simulating, and they are used in more complex hedging relationships. So this is all for the prospective assessing of the hedge effectiveness. And except for assessing the hedge effectiveness, you need to do the second thing, as I mentioned. Measuring the hedge ineffectiveness. And this is done retrospectively, so not at the start or the inception of the hedging relationship, and you would apply dollar offset method in most cases. So it means that you need to calculate how the fair value of the hedged item changed over a certain period, and how the fair value of the hedging instrument moved, and based on these movements you can calculate the ineffectiveness. So if you have a cash flow hedge, then you know very well that you are going to recognize the ineffective part in profit or loss and the effective part in other comprehensive income as a cash flow hedge reserve. So just a small illustration of what I have just said. Imagine you assume to make a sale in 6 months in foreign currency and you want to protect yourself against the foreign currency risk. So what you're going to do, you are going to enter into forward contract to sell the foreign currency exactly in the amount of the assumed sale. Well, this is a typical hedge of the forecast transaction. It is a cash flow hedge. And at the inception, you need to perform the prospective hedge effectiveness assessment. Are the terms of the forecast transaction sale and forward contract matching? Is the maturity date of the forward more or less the same as the assumed date of the sale? Is the notional amount of the forward the same as the amount of the assumed sale? So you get the point. At the beginning, you can't measure the hedge ineffectiveness yet because there are no data. Well, let's say that 3 months later, we have the reporting date. So you measure that the fair value of the forecast transaction increased by 100 and the fair value of the hedging instrument decreased by 110. Well, I just made it up. So you just measure the hedge ineffectiveness. It is 10 because the fair value change of the forward was by 10 higher than the fair value change of the forecast sale. So you book these 10 in profit or loss and 100 in other comprehensive income. Plus, on top of that, you still need to assess the hedge effectiveness prospectively. Again, compare the critical terms or perform any other method. Now, finally, let me tackle one more point from the question. Why is there a hedge ineffectiveness if the critical terms match? Well, notional amounts are the same, maturities are the same, so why? Well, the answer lies, in most cases, in a different credit risk. Forecast transaction or sale, your hedged item, well, it has no credit risk because there is no counterparty yet. But the forward has the credit risk because you have a counterparty. You need to enter into that forward contract with someone else, like a bank. So, due to difference in credit risk, the fair values of your hedged item and hedging instrument will be different, and you will have some ineffectiveness inside your hedging relationship. And that's it. The information in this podcast is not a substitute from a professional judgment of CPA of your own situation and circumstances, and you should consult CPA or other qualified professional. I need to say this. Thanks so much for watching until now. Please sign up for my channel if you liked it. Hit the like button. You can sign up even for our free newsletter with lots of articles, videos. We offer courses, other resources. So please share this video, visit cpdbox.com and stay tuned. Bye.